Hello again, traders. Duane Shepherd here once again from DRFX Swing Trading Mentoring. I'm going to be taking a look at a popular Japanese candlestick pattern known as double tops, which is a very common trading pattern that you'll see across the currency market as well as across all time frames. So I'm going to be taking a look at the general structure of this candlestick pattern, the dangers of this pattern, how you can trade it, and specifically going to be taking a look at a trading example of this pattern, where I traded the pound US dollar last week as the market transitioned from an uptrend to a downtrend on the 4-hour chart, using double tops as an indication that the market was going to be starting this transition. Now here you can see an example of a double top pattern, where essentially what takes place is that the market forms two bearish signals side by side, indicating that it is about to start a strong downtrend. So what takes place here is that the market will form a bearish signal, which will not start the movement but will pull back, and the market will then U-turn to form another bearish signal to complete the formation of the double top pattern and indicate the possible start of the movement bearish. Now the reason why I say the possible start of the movement bearish is that because the movements that lead to the formation of double tops is very similar to the movement that leads to the formation of consolidation, you have to exercise caution in terms of when we actually start to trade these double tops. So because it is possible that the market can rally at this area here, similar to what it did at the end of the formation of the first bear signal, the green light to indicate that we should start trading this signal is when we see a strong bear signal that breaks comfortably below this area here to confirm that the market is now starting the bearish movement. So that is something that we have to bear in mind when it comes to trading double tops, because often what happens is that we can see this double top pattern formed, and because we become anxious or because we do not want to miss the movement, we can enter the market here, placing a stop loss above the U-turn here, and expect that the market is going to be moving aggressively. Now, it is true that the market generally moves aggressively and fast, and that can lead to the temptation to want to enter the market quickly. But because of this trap that takes place at this area here, where the market could rally to instead of form a consolidation, we have to be patient in terms of waiting until the market gives us a signal that will confirm that it is now time to trade the market bearish and capture our intended trading gain. Now, another element to this double top pattern is that you can either have the market form this pattern with two evening stars side by side, whereas you can see here an evening star is basically a strong U-turn, where the market will have this bullish signal. It will then move sideways and form these small candlestick signals, and then provide us with this strong bear signal to complete the U-turn and complete the formation of this evening star. So you can have evening stars that lead to the formation of double tops, and you can also have bearish engulfing candlestick formations that also form these double top patterns as well. You can also have a combination of these two signals, where you can also have evening stars as well as bearish engulfing candlestick formations that are formed side by side to form double top patterns as well. So double top patterns are very common across the currency market, and you will generally see them when the market is transitioning from an uptrend to a downtrend. And another place that you will see them is when the market is forming consolidation patterns, as well as after the consolidation has been completed, where the market continues to move between the boundaries of resistance and support. Now, because the movements that take place within consolidation that lead to the formation of consolidation, as well as after the consolidation has been complete, generally are comprised of small uptrends and downtrends, you will generally find double tops that are formed as part of the formation of these consolidation patterns. So you'll see them formed at resistance boundaries, at resistance areas that indicate that the market is about to start a bearish movement as part of the formation of consolidation, or as part of the continuing movement between resistance and support, until the consolidation is either broken out bearish or bullish. Now, taking a look at the example that took place last week on the pound US dollar on its 4-hour chart. Essentially what was taking place was that the market was transitioning from an uptrend to a downtrend, which was very similar. This pattern of movement was very similar to what we see when the market is in the early stages of forming a consolidation pattern. So the idea was that the market was going to be forming this pattern here, double top pattern here, which was indicating that the market was going to be transitioning from an uptrend to a downtrend as part of the formation of this consolidation setup. Now, specifically to the signal, you can see here that the double tops were formed as part of the transition from the uptrend to the downtrend, breaking this uptrend line, indicating the start of the movement bearish as part of the formation of this consolidation setup. Now, as you can see here, the first component of this double top was formed by a bearish engulfing candlestick formation. As you can see here, the market did not respond to this signal and rallied, and it then U-turned at this area here to form a U-turn, somewhat similar in form to an evening star, to then complete the formation of the double top pattern. Now, this is where it gets tricky and where people can experience trading losses because of the temptation to exit the market, to enter the market too early. Now, because this type of movement is very similar to the one that leads to the formation of consolidation, where the market could have rallied at this area here, the best place to enter the market is after the market has formed this bearish signal that is strong enough and that closes comfortably below this area here to confirm that this is in fact a double top pattern and that we will in fact see a strong bearish movement. So this was a signal that was given, and when we're trading double tops that are part of the transition from an uptrend to a downtrend, the first target that we will aim for is the support point that was formed as part of the previous uptrend. So at 1.2438, this was where the market had formed its low in starting this previous uptrend. And when we're trading double tops, this is the first target that we would aim for as the market moves from an uptrend to a downtrend. So the signal was given, entry took place at this area here, and in most cases we would place our stop loss at the high of this formation that was formed here. So this was a setup, and as you can see here, the market hit the trading target at the support point, taking a very short time to actually hit this trading target. So this is another element or factor when it comes to double tops, is that these movements generally are fast and aggressive, and after you have entered the market, the market does not take a very long time to actually hit our trading target, which in this case is the support target. Now, in terms of entry and your stop losses and your risk to reward ratios, depending on the risk reward ratio that you have for your trading, you could have entered the market at the close of the candle, placing a stop loss above this high, or you could have waited until the market pulled back a little bit to give you a smaller stop loss and a larger trading gain as the market hits the support target. So it all depends on the risk to reward ratio that you have in your trading, and this is why entering the market as soon as the market closes with a candle may not always be the best option, because you can also sometimes get a better entry price as the market temporarily pulls back before hitting our trading target. So if you have any questions about this trading pattern, you can let me know. This trading example on the pound US dollar was a typical example of double top patterns, how they are formed, as well as how we can trade them to the support target. And once we're able to spot them correctly and trade them correctly, generally speaking, they can provide us with quick trading gains as the market moves from the uptrend to a downtrend and towards our support target. So if you have any questions, you can let me know by emailing me at shepherdduane@gmail.com. You can also find me on Facebook and Baby Pips using the same username, DRFX Trading, as well as on Twitter at worldwide876. And you can also check out my blog, drfxtrading.blogspot.com, where you can find several articles where I discuss several trading patterns and some of my trading results using the trading methodology that I now use. So until next time, traders, all the best.